My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today we got a special treat because our guest, Jeremy Roll, is a different kind of real estate investor than the ones we typically interview on this show. In that sense, it's because he is a very, very passive real estate investor. He is a true LP, limited partner on many, many syndications. In fact, he's been doing this for over 23 years at this point. And way back in, I believe it was 2007, the passive income he was making from his investments in real estate as a limited partner allowed him to quit the rat race. So he's kind of accomplished what a lot of us are looking to do in real estate, which is create truly passive income. So Jeremy, welcome to the show. Great to have you.
Great. Thanks for having me here. And thanks for everyone who's joining us. I hope it's helpful for everyone who's listening out there.
For sure. I know it will be. So Jeremy, give us a little snapshot. Right now we're in the middle of 2025. What does the portfolio currently consist of? How many different deals or projects are you involved in at the moment?
Yep. So I am currently in over 60 different LLCs. I've been in over 200 over the past 20 something years. Honestly, that's probably too many. I'm not a financial advisor. None of this is financial advice, just my perspective as an investor. But if I was talking to someone who was new today, I don't know that I wouldn't tell anybody to try to hit 60. This is just because I've been doing it for so long and new deals come up over time and some don't sell or some do sell. So after a while, it just, you don't have full control over optimizing it necessarily. It's not that simple. But I do believe in diversification, and especially when you're an LP, so you're actually making a bet on another person, you're giving up control to somebody else. I think that diversification is uniquely important when you're giving someone else control.
So what does that mean to you, diversification, amongst different asset classes or just amongst different operators?
Yeah, absolutely. So I consider diversification across asset classes, geographies, and operators. And of course, you can get into it at an even more granular level. But to me, high level, those are the three things that I'm always trying to be diversified across.
Okay, so right now, real estate wise, what's kind of your preferred buy box? What kind of deals do you like to get involved in?
Yeah, I got to be honest with you. I'm mostly on the sidelines right now. I am concerned for various reasons due to economic indicators about a potential recession. I don't know if there is going to be one, but I think from a probability perspective, it's reasonably high. And so except for really unique opportunities, I'm being very careful. And one of the challenges I have is I look for more predictable, stabilized cash flow opportunities. So I'm going into something that's 80 or 90+% occupied, may or may not have any value add upside. With that profile, you have to be very careful with the price you're paying because you're not adding a ton of value. So, for example, if there's a highly distressed deal these days, it's just not going to be a fit for me, but it could be a very good fit for somebody else, right? There's 1,000 ways to invest. None of them are wrong. It's just the best fit for you. And so, but because of the way I do it, pricing is key. And so right now I'm concerned about high prices as well as potentially being right at the end of a cycle.
So do you see that changing anytime soon? Do you see a tsunami of deals coming down the pipeline?
I don't foresee a tsunami of deals. It never really works that easily or that way, honestly. Of course, it's never easy. But what I do potentially foresee is a reasonable probability of a recession. And if a recession happens, there's kind of what I call a recession playbook or a bunch of dominoes that fall. And real estate moves really slowly. So it moves much more slowly than the stock market. And because of that, it takes a lot of patience to watch those dominoes fall and then potentially get the price adjustment or price reset that you may have been waiting for. So this is not like I'm hoping in 2 months there's going to be another spigot of opportunities. This is potentially in the next year or two, there may be a good amount of new opportunities at different pricing and today, but honestly, maybe there won't be. I don't know.
So you've been involved in a couple of hundred different syndications over the years. What are you looking for? Now, you kind of told us what you're looking for in a deal. What are you looking for in operators when you're investing?
Yeah, so the best way I can describe it, because you look for a lot of different things, right? You're trying to avoid people that are scamming. You're trying to avoid people that won't operate a property well. But basically, I'm trying to match my personality. So I'm looking for someone who's going to underpromise, be conservative with their projections, over-deliver as a strategy to try to build long-term relationships with investors. And what I'm trying to avoid high level is someone who has got a great marketing machine, is having tremendous projections with tremendous numbers, with maybe a really, really nice, well-polished presentation, but they have so many investors coming to them. They're not looking to build relationships necessarily. They're just looking to create a big funnel of people and just maximize the amount of capital they can raise. And honestly, if your deal doesn't perform to projections, they just have 10 investors waiting behind you, right? So I'm trying to avoid that because I'm really trying to find good operators I can build long-term relationships with. One of the key unique things, or not somewhat unique things about me, is I look for longer-term fixed-rate loans. And I'm typically looking for a 10-year fixed rate loan when I invest. And that means I'm going to have to kind of go into a deal and ride in the back of the bus with this operator driving for what could be 10, 15 years, right? So I have to be very, very careful who I'm selecting. And there's a lot of different ways to do it. And we could do an entire, show on just due diligence alone, for example. It's a very long topic.
Most definitely. So the last couple of years have been really, really rough on a lot of syndicators, a lot of multifamily guys, especially the ones that were doing kind of what you're talking about there. These very, very aggressive projections and, just basing things on the craziness that was happening over the last previous few years to that. A lot of deals are in a lot of trouble these days. What's your perspective on that, Jeremy?
Yeah. So the first thing I'll say is I did not invest in any of the floating rate bridge loan multifamily deals you're referring to. In fact, the only deals I've done, probably for the past 5 years on the multifamily side, have been 10-year fixed rate loans, sometimes a couple times 7-year, but mostly 10-year fixed rate loan, either tax abated or low income housing tax credit multifamily. And those specific niches were a defensive play with the possibility of being close to a recession, like purposefully, as well as getting kind of a better price or better imputed cap rate because you're adding a ton of value up front, changing the structure to being low income housing tax credit or tax abated when it wasn't. So I know it's a complicated topic. We don't need to get into all of it, but point being is that the pricing was too high for me. So I had to find unique opportunities or just didn't make sense. Now, to answer your question, I am concerned about some of these operators having these challenges. I feel horrible for the investor community in general because a lot of LPs are frankly either not getting cash flow, having capital calls, or foreclosures. And I hate seeing that. Why nobody wants to wish badly on anybody. I think that will eventually breed some opportunity for investors who have been patient and waiting. But I have to be, so what makes it very challenging for me as an LP right now is that if I'm going to look at an operator now to invest with that's maybe new, I have to be particularly careful to understand what challenges are they dealing with, what are they going to be, kind of focused on some distress versus focusing on the deal that I'm investing in with them, right? And you want to try to avoid some of those challenges. And one thing I learned in the last cycle back in 07, 08, 09 is that if you just have one foreclosure as a multifamily syndicator, kind of like you have a ding on your credit, you will not get the same interest rate buying your next building at that point. And a lot of people haven't seen it or haven't been through that, but I've seen it with one operator I invested with. And I actually was in one foreclosure so far throughout my whole history, but that was a really unique situation, one of those crazy, one-time things. But anyway, the point being is that you have to be very careful because you could be investing with a sponsor who maybe had one foreclosure a year ago or maybe coming up, and you are having a lower return for the same amount of risk because you didn't realize that their interest rate is actually higher than what the next person could have gotten on the exact same building. So there's a lot of unique challenges now that's going to, come into play with due diligence for LPs going forward because of how concentrated and how much volume there has been of challenge in the multifamily space.
Most definitely. So in the real estate space, are you looking at some other asset classes within real estate as well?
I always invest in many different asset classes. It's part of me being diversified. So I invest in pretty much almost everything except for hotels, where I have, and I'm currently in almost everything except for hotels. I would say I'm having the same challenge as multifamily right now. And it's just all a question of timing and pricing and cap rates and multiples. And frankly, I like to say that the best example I can give to people who are relatively new is Warren Buffett is currently sitting in cash. And the reason why he's sitting in cash in a nutshell is because he can't find good value. And what does that mean? It means he can't find companies to invest in at a reasonable multiple of their profit. I'm having the same problem. I cannot find buildings or any type of real estate to invest in at reasonable multiples because, in my opinion, the multiples are still too high and we have negative leverage in most cases. And that's what I'm going to be particularly focused on as we see things potentially adjust in the next couple of years, is looking for that positive leverage that I should be getting, I think, as an investor and seeing if that comes up or not.
So for a passive investor, it sounds like you put a lot of work into vetting deals and looking for opportunities. That has become your full-time focus these days. Is that correct, Jeremy?
It's been my full-time focus since 2007, so almost 20 years. And it's yeah, I think a lot of people picture people just sitting at the beach, but if you're really trying to do this right and you're trying to find more opportunities, get operators, you're going to have to just we were talking about this before the show. To me, this type of investing is a team sport. You have to create a network, build a network with your fellow investors, with investor groups, and with sponsors. And that takes a lot of work if you're going to do it right. And if you're trying to be really picky and only invest in a tiny percentage of the best of the deals, it's going to be a lot of work like anything else in life.
So where do you tend to, you kind of touched on it, but where do you tend to find these deals, and how often, two different questions. So where are you finding the deals, and how often do you find yourself reinvesting with the same operators on average?
Yeah, great question. So as far as, let me touch upon the reinvestment part first, because that's one's very quick. So the reinvestment part can definitely happen. If I invest first time with a sponsor, probably a good idea to wait at least several quarters or a year or two to see how, if there's a quarterly cash flow check you're supposed to be getting, is it in projections? Is it exceeding it or below? Why? What do their quarterly reports look like? Are they reporting everything you're expecting? Are there any other kinks in the armor that you're seeing? And so just be conservative with that. But eventually over time, my goal is to invest multiple times with a sponsor, because most of my work is upfront finding that sponsor, right? So once you find someone good, you want to make a bet on, you're going to want to make a bet on multiple times without going overboard, right? Because you want to be diversified across asset classes, geographies, and sponsors or operators, right? So that's very key. You don't want to put too much money, into one basket. As far as how I find opportunities, really at this point, I've been in this for so long that I get opportunities coming from like literally any which way, but it's all a question of networking. That's really what it comes down to. When I started, it was 5 years before the iPhone was launched. Okay. So I had to go to in-person meetings, and I lived in LA at the time. And I was very lucky that I was in the city with a lot of meetings, but I had to do it all in person. You can now go online, look at crowdfunding websites. You can look at kind of investor communities for LPs, and you can find opportunities much more easily now. You do have to be careful with those for many different reasons. There's groupthink, there's marketing, there's all kinds of stuff you have to watch out for. But if you're just about to start in this space, it is easier to find opportunities. And I'll tell you that finding opportunities is the hardest part of all this, really.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. So, Jeremy, if you were starting all over again today in this field, or you're advising somebody who's just kind of really wants to become a passive investor, are there any books or resources that you kind of really resonate with you, that you think, this guy or this gal has done a really good job with this book?
Yeah. So I'm going to give two different sets of books as recommendations. So the first is, if you're just I was in the corporate world for over 10 years. My last two corporate jobs were at Toyota headquarters and Disney headquarters, both in Los Angeles. To give you guys an idea, I have an MBA from the Wharton School. So I was a corporate guy. Okay. And so I understand where you're coming from. If you're just in the corporate world trying to figure this whole thing out in general, I strongly recommend reading Rich Dad, Poor Dad by Robert Kiyosaki. And then a second book after that, in this order, of Cash Flow Quadrant by Robert Kiyosaki. I think most people recommend the first. You don't hear about the second one as much. Read them in that order. A little repetitive, but really worth reading, both of them. As far as specific to syndications, et cetera, I would say there's a couple of books that I'd recommend if you're looking. A lot of people tend to start with multifamily if you're looking at that asset class. There is one book written by a sponsor that's really good, that talks a little bit about due diligence and just how to look at deals. The sponsor, the name of the person is Brian Burke, Burke. I think it's called The Hands-Off Investor, but I could be wrong. I don't have the best memory. But if you look up Brian Burke, you'll find it on Amazon. And the second one, and I'm forgetting the name of the book, but Robert Beardsley, Beardsley, he wrote a book, and he actually sometimes he's a sponsor. He used to be hired as an analyst to help people vet opportunities and even help sponsors do due diligence. So he's much more thorough. So kind of the first one is Brian Burke, high level. The second one is a little bit more detailed with Robert Beardsley. And between the two, you're going to start to learn really what to look for. And the great thing about investing in this type of real estate is that about 80% of that is transferable to any asset class, because you're going to have revenues, expenses, NOI, cap rate, interest rates, debt. So if you just learn one asset class first, and then you could transfer about 80% of that with some tweaking to any other asset class. So you can build a really solid base learning that, even if you have no interest in multifamily to begin with.
Oh, that's fantastic advice. Jeremy, thanks very much. I'm sure some folks who would like to connect with you. How do you prefer that people do that?
Absolutely. Yeah, no, thanks for everyone who listened to this. So hopefully it was helpful. So I'm happy to help anybody any way that I can. So don't hesitate to reach out to me. Best way is through my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com.
Perfect. Jeremy, thanks so much for being on the show. This has been great.
Oh, yeah. Thanks for having me. I appreciate it.
All right, everybody, take care, and we will see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.